Welcome back, everyone. If you're a focused learner trying to map out the often wild machinery of the modern stock market, well, you're in exactly the right place today. We're diving into an explainer on Axsome Therapeutics, ticker symbol AXSM. On the surface, this biopharmaceutical company is a total head-scratcher. It's a massive tug-of-war between staggering market performance and, honestly, mind-bending unprofitability. So let's pop the hood and see what's actually going on here.
Okay, let's dive into this. 1,763.23%. Just take a second to let that completely sink in. That is Axsome's 10-year total return. It absolutely establishes the sheer, undeniable historical success of this stock. I mean, over a single decade, early investors have watched their capital multiply more than 17 times over. Now, usually, when you see a number like that, you instantly assume you're looking at a flawless, highly optimized profit machine, right? But as you're going to see, the truth behind this incredible run is way more complicated.
Because getting to that massive return, yeah, it was absolutely not a straight line up. Just look at the jaw-dropping peak in 2019. The stock delivered a monumental return of over 3,500% in a single year. That alone is just staggering. But then, reality hits. Look at the brutal follow-up. In 2020, the stock dropped by over 21%, and in 2021, it completely crashed by a massive 53.6%. This perfectly captures the wild, stomach-churning ride investors have been on. It just goes to show holding this stock requires an iron stomach for extreme yearly volatility.
Section 1. The Profitability Paradox. So this brings us to the core mystery. How exactly does a stock create such astronomical wealth for its shareholders while simultaneously bleeding cash on its actual balance sheet? Now, what's really interesting about this slide is the immediate disconnect we're seeing. On one hand, we've got a phenomenal trailing 12-month return sitting right at 85%. By any standard in the market, an 85% return over 12 months is an absolute home run. But then you look right next to it, net income is deeply, deeply in the red. We're talking a staggering net loss of over $183 million. So they are rewarding shareholders massively while absorbing a brutal multi-million-dollar operational loss.
Let's break down exactly what that unprofitability looks like across the board. I like to call this the wall of unprofitability. First, we've got a PE ratio of negative 56.3, mostly because, well, there are literally no earnings to measure against. Then the price to free cash flow is at negative 112. But honestly, those bottom two metrics are the real alarm bells. Return on assets is deeply negative at nearly 28.5%, and return on equity is sitting at an astonishing negative 207%. To translate all that jargon for you real quick, these metrics collectively paint a picture of a company that is massively unprofitable, generating zero bottom-line return on its assets, and burning through shareholder equity at a terrifying rate.
So we kind of have to pause here and ask the obvious question, right? How does a company with a nearly $12 billion market cap exist, let alone thrive with such terrible bottom-line fundamentals? If all our traditional valuation metrics are pointing to a massive cash-burning liability, what exactly is that $12 billion price tag paying for?
Section 2. Explosive top-line growth. To solve our little paradox here, we have to completely shift our perspective away from the bottom line. Because frankly, we can't value Axsome on profits since there aren't any. Instead, the market is valuing this company purely on its sales, using the price-to-sales ratio. Axsome's current PS ratio is 18.73. That means investors are willingly paying a steep premium of over 18 times to own a piece of their current revenue. So naturally, the question is, what kind of growth justifies an 18 times premium?
Well, here's your answer. 133.5%. And this isn't just a standard growth metric. This is their 3-year revenue compound annual growth rate. This explosive, hyperscaling growth is the actual engine driving all the hype in that massive $12 billion valuation. The market is looking at a company that is literally more than doubling its revenue year over year on a compounded basis, and they're placing a massive bet that this trajectory will eventually outrun the current unprofitability.
And this brilliantly illustrates what that scaling looks like in hard dollars. Over the trailing 12 months, they pulled in over $638 million in revenue. That TTM revenue CAGR is sitting at an incredibly strong 65.5%. And tracking right alongside that operational growth, the price CAGR over the same period is over 103%. So the company is rapidly scaling up its top line, crossing that huge $638 million mark, and the stock price, it's mirroring that top line expansion almost exactly.
But here is the ultimate saving grace for Axsome. Look at this massive 91.67% gross profit margin.
This means that before we even start calculating all the R&D and operating expenses that drag them into the red, the underlying product itself is wildly profitable to produce. Almost every single dollar that comes through the door from sales is kept as gross profit. That 91% gross margin is quite literally the engine that makes investors totally willing to ignore a $183 million net income loss. Because think about the logic here. If you have a product that costs practically nothing to produce compared to what you sell it for, and your sales are growing at 133% over 3 years, well, eventually, those revenues are going to absolutely dwarf your fixed operating costs.
Section 3. Debt and Liquidity Realities. Let's move to the balance sheet and see how this builds, because crossing the finish line to profitability actually requires, surviving until you get there. If we look at their runway, their current and quick ratios, both sitting right around 1.5, tell us they definitely have enough short-term liquidity to keep the lights on for now. But then look at step 3, a debt-to-equity ratio of 2.20. Make no mistake about it, they are heavily leveraged with debt to fuel this rapid expansion.
And we have to ground ourselves in the daily reality of this business. Despite the explosive top-line revenue, the actual cash leaving the business over the last 12 months is still near $94 million. That gives them a negative free cash flow yield of 0.78%. So this cash burn, while it might be completely necessary for their hypergrowth strategy, is incredibly real and very, very expensive to maintain.
So what does this all mean? We are left with a seriously fascinating dilemma. We've got a company with an undisputed 1,700% 10-year return, driving 133% revenue growth with an incredible 91% gross margin. But at the exact same time, it operates with heavy debt, burns roughly $94 million a year in cash, and carries a massive net loss. Looking at these colliding realities, you have to ask yourself, with this explosive growth but massive cash burn, is Axsome priced for perfection or poised for a correction? Ultimately, it all depends on whether you believe their top-line velocity will eventually conquer their bottom-line gravity. Thanks so much for joining me for this explainer, and I'll catch you in the next one.